Great to be here. Hope everybody is doing well. As Anna said, I'm Matt Kluchenik. I'm a partner at Mayer Brown in its Chicago office and focus on derivatives matters, CFTC, SEC derivatives matters, including regulatory matters, enforcement, and some transactional items. Again, great to be here. For the next 10 minutes or so, I'm going to give an update on where we stand with respect to the security-based swap regime. And with that, I would kindly ask that we go to the next slide. So this would be ISDA, and we're going to jump ahead to the security-based swap slides. Great, thank you. So we all know the Dodd-Frank Act was passed 10 years ago, maybe hard to believe. It was almost seems like yesterday to some of us. And there's been a ton of rulemaking. And I think we probably, most of us know that an important part of Title VII, which regards derivatives, was Congress's recognition and the authority given to the SEC to promulgate and implement a security-based swap regime. And for a number of years, things moved a little bit slowly and perhaps measurably slowly vis-a-vis the CFTC's swap rulemakings. But importantly, late last year in December 2019, the SEC adopted rule amendments regarding cross-border application of security-based swaps, and that followed on a number of other rulemakings over the past several years, such that as we sit here today, we finally have a full-on SBC security-based swap regulatory regime. And so the timetable, the clock in terms of getting things in order, registration, so on and so forth, has begun to tick. The good news is, I would say, that while there are substantial differences with respect to the security-based swap regime and the CFTC's swap regime, largely the regimes are harmonized. And so some good news in terms of reduced or potentially reduced regulatory burden for those who have entities or firms currently registered as CFTC swap dealers. If we could turn to the next slide, please. Next slide here really just summarizes in very broad fashion the major components of the regulatory regime. Not going to go through all these, but going to touch on a few here. But as you can see, whether it's definitions, and we'll touch on a few capital business conduct standards, record keeping, reporting, so on and so forth, we do now have a fully baked regulatory regime. Next slide, please. This slide sets forth a timetable in terms of the implementation of the SBS security-based swap regime. The key dates really would be those November 1st and December 1st, 2021 dates with respect to the requirement to submit an application to become registered as a security-based swap dealer. As some of you may know, that process has started in earnest. It's a significant process. And we are fortunate to work with some clients in that respect. Next slide, please. So take a step back here and what's a security-based swap? So we probably all have an idea, generally speaking, what they are in the marketplace because we've seen them for quite some time. The market structure, at least, has been fairly well developed. From a regulatory perspective, security-based swaps include any agreement, contract, or transaction that would be a swap as defined under Commodity Exchange Act Section 1A47, but for the exclusion for security-based swaps, and critically is based on an index that's a narrow-based security index. When we talk about narrow-based security indexes, we're talking about those indices that have 10 or fewer components. Or it's based on a single loan or security or any interest therein, or it's based on a specific event, the occurrence or non-occurrence of a particular event relating to a single issuer or a narrow-based security index. So, for example, a CFD, a contract for difference, would fall within that last bucket. So in broad fashion, when we talk about security-based swaps, we're talking about these types of products. On the next slide, we cover just a few examples, distinguish between different types of swaps, security-based swaps. So we have, more traditional swaps, for example, a SOFR compounded versus a fixed rate interest rate swap. This would be a swap, not a security-based swap for purposes of regulation and subject to the CFTC's jurisdiction. As noted, products such as single name CDSs, narrow-based indices would be security-based swaps. And then we have a couple of other types of products that, such as forwards, options on securities that are technically securities, of course, but don't fall into the bucket of security-based swaps. And then finally, there's a bucket of mixed swaps. Those are jointly regulated by the CFTC and the SEC and include components of both securities as well as commodity-oriented swaps. On the next slide, we provide here, set forth a definition of a security-based swap dealer. So for those of you who are somewhat familiar with the CFTC swap dealer space, this definition I think will look familiar to you, a lot of the same elements. So when we think about who's a security-based swap dealer, we're looking at whether one is holding itself out as a swap dealer in security-based swaps, makes a market in security-based swaps, two-sided market, perhaps willing to take risk or willing to sell risk, regularly enters into security-based swaps with counterparties as an ordinary course of business, or engages in activity commonly known in the trade as a dealer or market maker in security-based swaps. To be clear, a commercial end user who's entering into a security-based swap for its own account to perhaps hedge risk certainly would not fall within the security-based swap dealer definition. I think in terms of the various factors that the SEC will look at, and the CFTC has expounded upon in numerous respects, is consistent with the dealer-trader distinction. So whether one's dealing or whether one is trading security-based swaps, big part of that has to do with whether or not the dealer is marketing these, is garnering compensation in the form of a spread, perhaps a markup, whether or not there's a standalone profitable business associated with activity in security-based swaps. So looking for really that kind of distinct business around writing exposures or taking exposures on security-based swaps. In the next slide, we have just a brief summary here of the DMinimus exception, again, consistent with the CFTC's rules regarding swaps, which basically says if you're not a large enough dealer in security-based swaps, then you're not subject to regulation. And if you're not subject to regulation or registration, as a security-based swap dealer, that takes you largely out of the of most of the burdens associated with the security-based swap dealer regime. So for those entities that can fall within the under the threshold set forth in this slide, most notably $8 billion in aggregate gross notional amounts over the past preceding 12 months, not required to register as security-based swap dealers. And clearly a big distinction as it has been in the CFTC swap space. Next slide, please. And here's our ever important CLE code, which I'll read, 20D2DR. Again, that's 20DTDR. On this chart, very briefly, the SEC in publishing its final rules set forth its expectation based upon its own analysis of who likely will register and to what extent. It's an interesting chart, perhaps academic, but it breaks down the various expected registrants with respect to security-based swap dealers. It's interesting to see it broken down in terms of banks, broker-dealers, and standalone security-based swap dealers. By far, as anticipated, at least the largest category is likely to be bank security-based swap dealers. The next slide, we talk a little bit about what's involved with registration. As noted, it's a major endeavor. Lots of information required. Again, relatively similar to the swap dealer registration requirements applicable or set forth by the CFTC. There are various categories and various forms for registration depending upon whether you're a standalone, for example, swap dealer, or you're a broker-dealer swap dealer. And so CARA obviously needs to be given to the proper category of registration. The registration process is directly with the SEC. At this stage, at least, there's no SRO interposed. As some of you may know, on the commodity side, the National Futures Association oversees swap dealer registration, but here on the security-based swap side, it is the SEC. And importantly here, just to focus on that last bullet point, for CFTC registered swap dealers, those dealers can elect to rely upon the SEC's alternative alternative compliance mechanism during the registration process, so long as notice is provided to each of the regulators, the SEC and the CFTC. And we certainly expect that to happen. On the next slide, please. Here we set forth some of the requirements and really important certifications that are required, SBSE-C. And the focus here is on certifications by a senior officer, as well as the chief compliance officer, in terms of making certifications that appropriate and sufficient written policies and procedures have been implemented. So that's a certification, as well as with respect to associated person absence, no associated persons being subject to a statutory disqualification. There is some relief with respect to non-APs involving non-U.S. counterparties, but relatively limited. And these are two of the many important certifications that are required in regard to an application. On the next slide, we touch on really just an important, critically important component of the regulatory structure here, and that is the role and focus on chief compliance officers. And so no different than with respect to the CFTC swap dealer regime. Here, I'd say the CCO is really at the center of the regulatory regime. Critically important, on the next two slides, we set forth some obligations and some requirements. And one thing to focus on in particular is the ever important creation of the annual report, which sets forth a number of really important and potentially sensitive pieces of information, including things such as material noncompliance. And again, follows largely similar to what we see in the CFTC space. Very briefly, early on with respect to CCOs involved with swap dealers, there was a bit of confusion and a lot of questions about certain roles, certain duties with respect to exercising responsibilities, and quite frankly, whether or not to address things and how to address things in CCO annual reports. I think, you know, if not necessarily a body of law, some really helpful guidance has been developed over the years, and large credit goes to the CFTC for issuing that guidance. And I think security-based swap dealers, at least initially, will be able to look towards that guidance in terms of making inroads with respect to the CCO role. And so with that, thanks again for all of your attention for that very, very high level security-based swap overview. And I'm going to turn things over to my partner, Curtis Doty.
Thank you, Matt. Can everyone hear me all right?
Yep, all good.
Okay, thank you very much. My name's Curtis Doty. I'm a partner in the banking finance area, and I focus on derivatives on the transactional and regulatory side. And a big part of my practice is actually enforceability and netting and insolvency issues. But today I'm going to talk about Libor transition as it relates to derivatives. And, as we all know, banks don't fund themselves in the interbank market anymore. LIBOR is going to go away, and we need to start thinking proactively about what's going to replace it and how that's going to affect our derivatives portfolios. The issue under the current 2006 ISDA interest rate definitions, which are one of the basic Lego building blocks that go into a lot of derivatives confirmations, the issue is that the USD LIBOR BBA fallbacks run out if the reference banks don't provide quotes for interbank borrowing. I'm going to focus on USD LIBOR, but there are similar issues for other LIBORs and similar but issues that are treated slightly differently for IBORs that aren't LIBORs. So the solution is something that ISDA's been thinking about and consulting with membership about for quite a while, but they're going to update the definitions to fall back to adjusted risk-free rates, such as compounded in arrears SOFR plus a static spread adjustment, following a so-called index cessation event. Now, the index cessation events are going to be either a permanent cessation of LIBOR or else a finding by the Financial Conduct Authority, which oversees the administrator of LIBOR, a finding by the FCA that LIBOR has ceased to be representative of the cost of borrowing and the cost of funds. And the spread adjustment methodology is to use a look back over 5 years of what the historical median difference has been between LIBOR and SOFR, the basis spread adjustment upon that. The spread adjustment will become locked in when there's an announcement of a index cessation event, but it's important to bear in mind that this announcement can be prospective. So, for example, the FCA could say later this year that we've determined that as of June 5th next year, LIBOR will no longer be representative. So an important and somewhat subtle distinction to keep in mind is that the spread becomes locked in upon the announcement, but the actual fallback doesn't kick in and doesn't become effective until the actual non-representativeness occurs or the actual cessation occurs. And the reason for this, if you think about it, is pretty apparent. If people knew in advance that there were a definite period of time over which the activity in the market would be factored into this 5-year historical median, that would set up a great moral hazard for all the rates traders in the world to try to outwit each other and to try to trade in such a way that the spread fixing is favorable to their book. So we wouldn't want all of that brain power to be wasted in this such an unproductive activity. So that's why the spreads become fixed when the announcement is made. If I can have the next slide, please. So I'm going to address how ISDA is implementing the fallbacks. Bloomberg is currently publishing a running indicative spread based on the methodology I've just outlined, and that's what the spread would be if today were the rate fixing date. And when the actual rate fixing date happens, or spread fixing date happens, then that number will no longer be updated, and that will be the fixed spread. And it's going to be different for different tenors because different tenors have different correlations to SOFR compounded over the relevant tenor. ISDA's just announced that on October 23rd, it's going to launch a protocol to enable market participants to incorporate a new supplement that has these fallbacks into legacy documents, as well as a supplement to the 2006 definitions, which would be effective for confirmations entered into after the effective date of the supplement and would incorporate fallbacks into new contracts. So the protocol is meant to address legacy contracts, the supplement new contracts, and the effective date for both of these will be January 25th, 2021. And the reason for that big lag period is to allow market outreach to try to get as widespread acceptance of the protocol and as widespread adherence as possible, so that when the effective date comes around, portfolios will be updated and amended on a big bang basis. And what that does is that minimizes valuation disruptions to the extent the fallbacks are valued differently than contracts without the fallbacks in them. So the idea is there's going to be massive outreach, and the goal is to try to get adherence that's as widespread as possible before the January 25th date in 2021. Next slide, please. So I've mentioned the supplement for new contracts, the protocol for legacy contracts. There's also going to be a set of bilateral templates that ISDA will publish, which allow parties to either bilaterally adopt the protocol amendments, or if the parties have adhered to the protocol, to make certain modifications to the amendments that would otherwise be made by the protocol, such as by disapplying the pre-cessation triggers that are hardwired into the protocol and supplement, as well as excluding certain existing documents from being amended by the protocol. So for example, if you've got a swap that's tied to a loan and is hedging that loan, you might want the fallbacks to match the loan rather than to match the new supplement. Next slide, please. So I mentioned the protocol on this slide. I'm going to tell you how it works. There have been, consistent number of ISDA protocols over the years. The most recent one, which audience members might have had to have contended with, is the QFC stay protocol. The protocol is intended to be a really efficient way of amending wide portfolios of documents. And what it does is it allows parties to adhere to the protocol by submitting an adherence letter and a $500 adherence fee to ISDA. Once you've adhered to the protocol, you're effectively saying to everyone else in the market that if you also adhere to the protocol, we're agreeing to amend all of the protocol-covered documents that exist between us bilaterally. So it saves you the labor of having to contact each of your counterparties individually. Instead, everyone who enters into this protocol stadium and who has documents with anyone else in that stadium is able to amend those documents through this, if you will, so-called public offer and acceptance mechanism. The amendments actually take effect on the later of the January 25th effective date, and the implementation date, which is the date that either you've adhered and your counterparty has already adhered, or vice versa. So it's the date as in respect of any particular agreement, it's the date at which the later to adhere party to that agreement has adhered. And it's not like a Roach motel. You can revoke your adherence, but if you revoke your adherence, you have to give a notice. That revocation becomes effective at the end of the next calendar month after which you've submitted your revocation letter, and revocation doesn't affect the amendments that have been effected with other parties that have adhered prior to your revocation effective date. Next slide, please. Concluding thought is that the fallbacks are intended as a safety net to provide the widespread chaos of having a lot of contracts with indeterminate effects once Libor is no longer being provided and reference banks don't quote. But it may not be the optimal way of transitioning your portfolio. So once you've got the safety net in place, parties may want to consider how to voluntarily transition their portfolios in advance of the date in which the fallbacks kick in through either negotiated closeout, amendments, basis swaps, portfolio compression. The idea is to close out in a manner that allows you to have some price discovery going on rather than being locked into the spread adjustments, which are basically statistical constructs. And hopefully now that all the rates traders have been liberated from trying to second guess one another in the period between fixing and effectiveness, they can apply their creativity to ways to facilitate voluntary transitions between the parties once the safety net of the fallbacks is in place. I was trying to think of a good quote to summarize this. The best I could do is in the management aisle when martial arts writings were fashionable with management gurus. You could see Musashi Miyamoto saying, in preparing for a duel, you pay homage. I'm going to paraphrase. You pay homage to the fallbacks, but you don't rely on them to win the battle for you. And with that, I'm going to hand it over to Marla.
Thanks, Curtis. Just waiting a moment for the slides to catch up. So earlier this year, the final covered fund revisions to the Volcker rule were announced, and they're effective, or were effective as of earlier this month on the 1st. There's several categories to these changes, many of which will sound familiar because they, in a lot of cases, echo earlier relief or no actions that were given. So as a quick overview, these changes included codifying the foreign excluded fund relief for non-U.S. banking entities. And this is an example of one where this is really just codifying the earlier no action relief that had been granted. And it's also the same for the Super 23A. We're also seeing some easing compliance burdens for some of the existing exemptions, which I'll touch base on a little bit more thoroughly on the next slide, and as well as creating 4 new exclusions, including the one that most of the people on the call will probably be most interested in, which is the customer facilitation vehicles. And then we've also seen a narrowing of the definition of ownership interest, here largely to just carve out debt in certain cases, and also clarifying the treatment of parallel direct investments. So if we look on the next slide, I'm going to circle back to the modifications to the existing exclusions. So 4 main categories that we've seen changes to here. The first of which is loan securitizations. So this is really just a codification of the 2014 FAQs for the exclusion for loan securitizations, and basically a qualifying loan securitization vehicle may hold up to 5% of debt securities. Then foreign public funds, where we've largely just seen updates to the definition of public offering and modified restrictions on the sales of ownership interests to employees. Public welfare funds, they've updated the definitions to include new fund types, specifically rural business investment companies, as well as some qualified opportunity funds relating to the Opportunity Zone programs under the Jobs Act. And then the final category here was for small business investment companies, and really just clarifying the treatment of what will happen when a small business investment company has either voluntarily surrendered its license, where it'll still qualify for the exemption, or where it's been revoked, where it will no longer do so. Then the new exemptions on the next slide fall into these 4 categories. The first of which is for credit funds, which is really any fund that makes loans, invest in debt, pretty much exactly what you think it is. And then just as a general note, all of these have set conditions in the new rules, which are largely the same, but I'll discuss in more detail in the context of the customer facilitation vehicles. For venture capital funds, following, which is as defined in the Investment Company Act, and then for family wealth management vehicles and customer facilitation vehicles, as noted. So customer facilitation vehicles is going to include any issuer formed by or at the request of a customer for the purposes of providing exposure to a transaction, investment strategy, or other service, which is a very vague category, which is what's going to make it most useful. Can we see the next slide, please? So as mentioned, it will cover any vehicle that's created by or at the request of a customer. But as an important note, this does not mean that it's going to be a reverse inquiry requirement. It can be something that's developed really as a conversation between both the future purchaser and the issuer, including their affiliates. And you're allowed to have kind of unlimited discussions about the structure beforehand, both the economics of that structure, as well as any of the legal, regulatory, or tax benefits that could go along with the vehicle structure. And you're also allowed as an issuer to market the customer facilitation vehicles or your services in creating them to customers ahead of time. And there's also, as I mentioned, no restrictions on the underlying assets, meaning you can use this to provide exposure to really any of the equity classes that previously would have been prohibited under the Volcker rule, any of the covered funds, including hedge funds potentially. So as mentioned, there are certain conditions that will have to be complied with. The largest of which is that all of the ownership interests are going to have to be held by the customer whose requests the vehicle was created in connection with. That said, that can include any of its affiliates, and there is a carve-out of 0.5%, really just for legal purposes to create separateness. There also can be no direct or indirect issuer guarantee of the obligation, so the banking entity does have to fully separate in that way from the economic exposure. And as one would expect, this is also going to be subject to the Super 23A and Reg W requirements. The Super 23A requirements also having been slightly modified by the new rule revisions. And you're going to have disclosure and record keeping requirements. So the disclosure obligation is consistent with what's already in the Volcker rule, and really what you would expect to see in connection with these transactions. And with that, I'm going to hand it off to Tom to talk about some of the new tax issues that we'll want to be looking out for.
Thanks very much. Tom Humphreys here from the Mayor Brown, New York City office. Great to be with everybody today, although it's on WebEx. So I'm the tax attorney, and my mission today is not to talk about super technical tax details. It's really to step back and talk about what the future might hold in the U.S. in terms of tax and tax policy. And of course, we all know that on November 3rd, we've got a election here in the United States. And I think it's easy to say that what happens in that election could have a major impact on tax policy in the United States. Remember that we have, and for those of you in the U.S. and those of you outside the U.S. in particular, we have a presidential election, we have Senate elections, and then we have the entire House of Representatives. So the way I sort of look at what could happen, I break it down into what are the combinations you might get out of the election, and then when would you have a big change in the tax law, and when would you have a small change or very small changes. So big change, and this is what people are calling the blue wave right now. We'll see on November 3rd. But a big change would be a President Biden or President-elect Biden on November 4th or whenever the votes are counted. And then it would also be a Senate majority in the Democrats. And remember, that could just be a 50% a 50% or 50 Democrats and 50 Republicans, and the Democratic vice president could break a tie. So that's all you need here. And then the House of Representatives, you want to see, did that go Democratic too? And the big change would happen if all those things lined up on the Democrat, the Democrat Party. So the small change would be any variation of that, a President Trump and a Democratic Senate, Democratic House, a President Trump, Republican Senate, Republican House. I mean, those are the other obvious possibilities, maybe not obvious possibilities, but possibilities, shall we say. So let's talk a little about the big change. Now, one thing I want to point out is that you may have heard in the United States Senate, you need 60 votes to break a filibuster. And so you say, well, what difference does it make if it's 50-50 with a Democratic vice president? And the answer is something called reconciliation. And this was something that was used to pass the Tax Cuts and Jobs Act. And bills that are under budget reconciliation in the Congress only need a bare majority in the United States Senate. So you don't need 60 votes, and you don't worry about filibuster. Now, to be under reconciliation, you have to meet certain requirements, and we're not going to go into those. But most of all, there's something called the Byrd Amendment. And so once you get a little down the road in terms of reconciliation, if you're going to add a provision that loses revenue, you have to make that up with a provision that raises revenue. Now, as you see, that may not be a big problem here because if you look at what's out there from Vice President Biden, there is about $4 trillion of revenue raising over a 10-year budget horizon, half from individuals and half from corporations. So anyways, that's why on November 4th or whenever the ballots are counted, you want to look and see what's going on with the presidency, what's going on with the Senate. All right, but let's talk about that big change. Small changes aren't very much fun to talk about. And so let's talk about the big change. So first of all, would be rates on ordinary income. And so under Vice President Biden's plan, we would go back to the pre-Tax Cuts and Jobs Act rate. So we would go back to a 39.6% rate. Now that would only apply to incomes above $400,000. If you notice the TV ads, the vice president is saying, look, I'm not going to raise anybody's taxes if you make less than $100,000. And that's where that's coming from. The rate increase would only apply above $400,000. A big one for this group, long-term capital gains. So right now, long-term capital gains are taxed at 20%, which is historically, one of the lower rates that we've had. Under the Biden plan, what would happen to long-term capital gain rates for incomes over $1 million? Long-term capital gain rates would be the same as ordinary income rates. So they would go from 20% up to 39.6%. So that's a giant change. Would be a giant change. So those are kind of the headline items on the individual rate side. Corporate tax rates would go up to 28%. So right now they're 21% after the Tax Cuts and Jobs Act, then they go to 28%. There'd be a 15% minimum tax based on a corporation's book income. We've had things like that in the alternative minimum tax over the years. It looks like this one might have more teeth and might be more directly based, shall we say, on accounting income. Another one for the vice president is no basis step up at death. So right now, if an individual dies owning appreciated securities, the tax basis in those securities is stepped up to fair market value at the time of death, which means when they're later sold, you start from that point in terms of gains. And what that does is it locks in, we have a lock-in effect, they call it, where as taxpayers get older with appreciated stock positions, they're incredibly unlikely to sell those positions because they know when they die, they'll get a step up in basis at death. And I'll come back to that when we talk a little about how are people going to react between now and the end of the year, depending on what happens in the election. A couple of other changes, IRAs might go away. and be replaced with some sort of refundable tax credit for contributions to a retirement plan. So that could be pretty significant. The outlines of that are not entirely clear. Carried interest. So an investment advisor who has a share in the profit of a fund, and now if they hold that interest for 3 years under the Tax Cuts and Jobs Act, they get long-term capital gain. Well, carried interest now under the Biden plan would be taxed at ordinary income rates. There'd be a risk fee on liabilities of large financial institutions, somebody with assets of 50 billion or more. So a couple of other things, and maybe I should have said this at the outset, but when I talk about the Biden plan, well, it's nowadays there are not clear, definitive plans that either campaign releases dealing with taxes. That's just not the way things work. They haven't worked that way for a while, maybe always. But so when I talk about the Biden plan, there are certain headline items that he's talked about. Raising your taxes. He will sit there in a fundraiser and tell the people sitting 10 feet from him, "I'm going to raise your taxes." So there's little doubt about that one. But other things, you have to sort of read the tea leaves. Some of the tea leaves go back to the Obama administration, 2016. People are looking at the Obama administration budget proposals in 2016 and maybe even before to try to figure out, well, what would a Biden sort of tax policy look like? But that's a caveat here. The plan I'm talking about is sort of pieced together from publicly available information. So this group is usually interested in mark-to-market for derivatives. You notice I haven't mentioned that yet. Well, at least so far in what the vice president is talking about, mark-to-market for derivatives has not come up. Having said that, I think that it was in the 2016 Obama budget, did not become law, by the way, but mark-to-market for derivatives, I think, could easily be part of a Biden tax policy. So I think what we would be looking at in a Biden presidency with a Democratic Senate, Democratic House, would be rate increases on individuals at the upper income, capital gain rate increases, higher corporate tax rates, and some other provisions, including, again, don't write it off, as it were, mark to market. So I think another thing that people have sort of not focused on as much is, what about tax administration in a potential Biden administration? What would that look like? Now, if you want to know, you want to get some idea, you should go on C-SPAN, and you should look at a hearing that was held last week, the House Oversight and Reform Committee, a subcommittee on government operations, headed by Jerry Connolly, a Democrat from Virginia. And they had Chuck Rettig, who's the current commissioner of the Internal Revenue Service, testifying. And the opening statements from particularly the majority members on that committee are pretty instructive, because it's clear they are interested and willing to actually come up with more money for the Internal Revenue Service to seek more aggressive enforcement of U.S. tax laws. And that seems to be a theme that is a theme that was very present in that hearing last week. And I think if you talk to people down in Washington, that is something that on the Democratic side of the aisle, they are definitely talking about in terms of, should you have a Democratic administration? So increased enforcement, and usually they try to go where the money is. So that would be the upper income levels. So now maybe what I'll finish up with is just talking a little about, well, how about tax planning? So this is, I had an interview with a reporter last week, and all she wanted to know about was, what are people going to do this year if there's a blue wave? Are they going to accelerate income? Are they going to defer deductions? Tell me about all these tax strategies that people are going to be coming up with. And of course, my easy answer is it's too soon to start tax planning for something where we don't know what the outcome is going to be. And so with that caveat, I think putting my sort of tax planning hat on, some of the things are fairly obvious. Accelerate income. So if you've got a lower rate environment, you do things that would accelerate income. Now, as far as this group is concerned, I think what that would translate to would be sales of capital assets. And so if you thought that after you get a blue wave, and I'm not saying that's going to happen, but after that happened, and if it was really significant, so you were pretty sure that the Democratic Party could get their agenda enacted, people are then going to be seriously considering, okay, effective dates. That change in capital gains I told you about, capital gain rates, when would that take effect? Would it be 1/1/20? That's certainly possible. Even if Congress didn't get to that provision until later in the year, Congress has the ability to make those kind of changes retroactive. Something like this, I think it's a little less likely simply because of market disruptions, but that it is certainly possible the change could be effective 1/1/20. And if it were not, then I think 1/1/21. If it were not, 1/1/22 would be clearly on the radar screen. And so in December, people are going to be looking at that and saying, well, should I sell my stocks today and pick up that 20% rate? Obviously, I have to pay the tax today. Or should I wait and take my chances with whatever's going to happen in the new administration? And again, the larger position you have, to the extent your taxable income exceeds $1 million, you're looking really a dramatic tax increase on capital gains. Now, I don't know, it looks like we've got a CLE code there, 20 DTDR, for those of you on the phone. But if I don't know whether this would extend to this extent, but this is the kind of thing it's kind of fun to think about, or maybe not fun, but interesting. It would be, again, an elderly taxpayer with an appreciated financial position who was counting on the basis step up at death and now believes that may not happen. Would it make sense in that case to take that stock out of the lockbox, sell it, and recognize a gain in a 20% world? I think when you really look at reality over the last 20, 25 years, not everybody these are very uncertain inputs into somebody's decision making. And so some people will act on them and many people will not. So we would just have to see. So I think triggering capital gains could well be something that people would be looking at if, again, you think there's going to be a Democratic administration, Democratic Senate, Democratic House. Income acceleration, sure, ordinary income. Again, things like salary, things like that, a little hard to accelerate, shall we say, but bonuses, things like that, people might think about. So, it's always interesting to speculate, but I'm going to stop myself here because we're out of time. But, I think it'll all be quite fascinating, and we'll just have to see what happens